attendees are in listen-only mode.
Good afternoon and welcome to today's Premium Account ASX Top 50 Market Update. The information is prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Global Equity Management and Investment Manager for the Investor Signals Unit Trust. I have 17 years of experience in the financial services industry and a licensed securities advisor. The format for today's presentation, we look at the global macro outlook driving equity markets. We review the ASX Top 50. We tie that in with our financial year 14 earnings per share outlook. We take into account that we've got the upcoming AGM season, so we focus on the companies that will be the first to schedule their AGMs. We also take into account that we're just heading into the third quarter of US earnings, which began last night with Alcoa reporting their results, and we conclude with a short-term summary around our portfolio allocations and our market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Moving straight into a graph of the US market at the moment, and clearly the issues that are coming out of Washington are creating a lot of uncertainty at a macro level. We've maintained for some time that fair value for the US markets back down at around 14,500 points on the Dow, I should say. So we could see up to another sort of 5% downside to equity values before we get into a consolidation pattern. I think the key point to focus on, I suppose, with the US, and are we likely to see some type of resolution that's not too destructive for equity markets? I think what we're seeing is the Republicans attempting to sort of bring the combination of the budget negotiations into the same sort of deadline or timeline as that of the debt ceiling, which the date there's the 17th of October. So we'll probably see continued delays and standoffs in negotiations for a further 7 to 8 days, but I would expect to get into the middle of October and start to see some resolutions. There'll be some compromise that are likely met, and both parties will claim a victory to a lesser or greater extent, and the debt ceiling will ultimately be raised. So I think, whilst the equity markets are going to struggle to move higher until that resolution's passed, I think we have to brace for the fact that equity markets could move a little bit lower. That doesn't mean that there's not current buying opportunities in the Australian equity market, and I'll focus on some of those names as we roll through the top 50 today. Just to conclude on this macro view, we'll just have a quick look at a couple of other key barometers. So this here is the 10-year Treasuries. We follow this reasonably closely. So during what we're seeing at the moment is a little bit of doubt creeps in around US growth and the prospect of inflation or GDP picking up in the US. We're seeing the 10-year yield on the 10-year Treasuries fall from sort of that 3%, which is reasonably elevated considering where it came from probably only 6 months ago, travelling around 1.7, 1.9%. We've seen that pull back from 3 back to 2.6. I think ultimately tying in with our target of the Dow finding support around 14.5, we could see the 10 years back at around 2.5%. All in all, that should bode well for a continued sort of ongoing recovery in the US housing market as we continue to see mortgage refinancing and new home buyers drive into the market off those lower interest rate environments. I think as the interest rate started to peak there, we saw a little bit of weakness in the housing market in the US during August. However, on an annualized basis, US housing prices are up around 12%. We're seeing similar trends in Europe and likewise, obviously, in other parts of the world. On the currency front, what we're seeing here is as the US bicker over the budget and ultimately the deficit ceiling, we're seeing a weak US dollar environment. So under that scenario, we've seen the Aussie dollar perform a little bit better. Tie that in with the fact that probably the RBA won't cut rates in November. I think they'll leave the status quo, but if global GDP continues to track below trend, and in particular Australian GDP remains weak and we have tame inflation, which is certainly the current expectation, is we'll probably see a further 25 basis points cut early in the new year. So in that environment, I'd expect the Aussie dollar to remain fairly buoyant until such time as we get through these resolutions in the political standoff in Washington. Okay, so on that note, let's move straight into the XJO and then into the top 50 stocks. So at 15 times forward earnings, or closer to 15 times forward earnings, our market's reasonably expensive. I've been chatting about that, but given that those global bond yields and in particular Australian yields are at historical low levels, a lot of money's being pushed into equities. The question is, can global GDP start to re-accelerate over the next few years? I think it probably can do. I think central bank policy will ultimately be supportive for global growth, and we should continue to have a reasonably solid environment for owning equities. We are drawn towards the best quality names within the market, and I am very adamant that you need to be running a covered call strategy over those names to justify holding them, because down at sort of 3-4% dividend yield, it's not enough when we've got a relatively slow global GDP backdrop. So we don't expect top-line revenue and earnings growth to really accelerate in these companies. So to get your 10-15% return per annum, definitely need the call options in there as a strategy. So from our point of view, our market is certainly well supported by yield down at about 4,800 points, but certainly we could expect to see it even just bump sideways at or near these levels until we get into probably the early part of November, and we'd expect to see equity markets gradually start to trend a little bit higher again. Okay, so in today's recording we roll through the top 50 companies. There's a lot to get through, so I'll do my best to cover off on sort of the key points and move through them reasonably quickly. AGK, we're looking for earnings growth in 2014 of around 5 to maybe 8%. The stock's well supported by yield and allowing for about 8% earnings growth. The stock trades about 13 times next year earnings and on about a 4% dividend yield. I'd expect to see it continue to bump sideways here at around this sort of $15 to $16 range. We've sold calls at or near the current level. They're European, so we collect the upcoming March dividend, and we're fairly comfortable that the stock should bounce up against sort of that ceiling there around $15 to $16. Asiano, look, this is a name that we've watched closely, but we haven't allocated it in the portfolio. The company's focused on some cost-out initiatives and continued ongoing savings. If it was to pull back to around this 525 level, we're willing to take a look at it, but not doing it there in Asiano at the moment. Amcor, we've seen some slightly negative numbers from its global peers over the last 2 or 3 days, and that's what's weighed on this price. I think ultimately Amcor's more resilient at around 8 to 10% EPS growth over the next 12 months and 15 times forward earnings and about a 4.5% dividend yield. The stock should be well supported. I've spent a lot of time chatting about the Australasian packaging distribution business, which will be demerged. I think that will help to unlock some value, so we're definite buyers of Amcor. Given the macro backdrop in the US at the moment, it's hard to say where support will come in, but I don't expect to see any really major adjustment to the downside. I think Amcor should, as a minimum, be able to deliver 5% earnings growth and unlock some value through this spin-off, so we're happy to be buyers of it on this weakness. AMP, not doing anything there at the moment. Just to put some numbers on that, about 14 times forward earnings and trading around a 5% forward dividend yield. ANZ, around 13 times earnings and about a 5.2% dividend yield. Should only grow earnings around 3%. So the ANZ, Westpac and NAB come into their dividend-paying period during November and December. We're happy to position in these banking stocks. We're certainly not overweight in them, but we're happy to be owners of ANZ at or near this level and sell the European calls into the end of the year, collect the November div plus the call premium. That's boosting that cash flow return out of ANZ up to around 10% and giving us the opportunity for some small capital growth from where we sit at the moment. I'm not doing an APA. ASX, so there's some commentary out at the moment where under the Liberal government, we might start to see a little bit more clarity around the longer term restrictions for competition for the ASX, which will ultimately be supportive for share price. That's where we've seen the small pop in the share price today. But from a day-to-day perspective within the business, we're not looking for a lot of earnings growth here. So it really is, can the company defend its current profit rate and revenue rate? And can it maintain its dividend yield? I think the answer to those questions is yes, it can. It doesn't leave a lot of upside for capital growth for investors in the absence of any sort of capital or any corporate action, I should say, whether we see a sort of takeover back on the table. But until then, I think market volumes, we're not expecting any huge pickup. The derivative volumes for ASX have been strong. Equity volumes have been a little uninspiring, but at around 5% dividend yield, trading about 17 times forward earnings, we're happy to own it here and try to sell the covered calls up at around this $36 level, again boosting that cash flow up to around 10% per annum. AZJ, now this is expensive. The market's paying up, sort of already pricing in about 20-odd% earnings growth over the next 12 months. This stock trades on a very high multiple, up at around 19-20 times forward earnings. I think certainly it's a buy on the dip story. So if an opportunity came up, over the course of the next week where we could look to accumulate AZJ gain back down at around 450, we'd be keen to do so. BHP, I think this is an area of the market where investors might be underestimating some of the earnings growth potential here. We're seeing iron ore prices remain elevated. We're seeing petroleum prices remain elevated. We're seeing a lot of discipline within capital expenditure. So we look towards the upcoming AGM for BHP for further guidance around maybe their capital policy with further dividend payouts or share buybacks. But ultimately, even irrespective of any improvements on that dividend front, with the stock trading currently at about 4% dividend yield, 11 or 12 times next year earnings, and analysts having lower spot iron ore prices in their models, we could start to see further earnings upgrades. I think BHP could be trading back up towards $38, $39 towards the end of this year. Brambles, only growing at around 5% per annum. We'll look for the AGM to provide further guidance around the timing of the spin-off, the recall business, but that should take place this side of Christmas. I think a combination of the slightly lower Aussie dollar, marginal pickup in business in Europe, Brambles is reasonably well supported. Our target here is we own it at lower levels at around $9.50. I think it starts to get expensive, so we're selling covered calls, but we're boosting that dividend yield in Brambles from around 4% up to around 10% as a combination of that call premium and the dividend income. And on a forward basis, we think the company can deliver sort of 5% earnings growth. CBA, probably 3% earnings growth is probably where we see CBA over the next 12 months. At 15 times forward earnings and a 5% dividend yield, the stock's simply back in fair value range. We were looking for it to pull back a little bit further down to around sort of $68, $69, and we'd be buyers of it. That would effectively tie in with our 14,500 target on the Dow, so we'll continue to watch that, but we may not get that opportunity to buy CBA back at that 68 level, so we'll continue to sort of keep a close eye on that. Coca-Cola, so the company disappointed in their most recent earnings result. The only bright light here is, do we see commentary out of the company in the next 6 months around cost control? I think we can probably get back to a point where Coca-Cola delivers reasonably flat earnings in the next 12 months. That puts it on a forward dividend yield of around 5% and about 16 times forward earnings. So we've been buyers of it at lower levels here at around $13. I think that stops the upside rally. So we look to sell covered calls somewhere between this $12.90 and $13.25 level. We'd just like to see the stock a little bit higher, around $12.50, before we sell those calls. Again, boosting that cash flow up to around 10% per annum as a result of the dividend and the call premium. Computershare, on a forward basis, the company hopefully delivers somewhere between 8 to 12% EPS growth. We've seen them continue to expand their footprint into the US and into Canada. I think the argument here for Computershare is it's a beneficiary of a lower Aussie dollar. It's tied into faster growing US markets. We're looking for recovery in sort of listing activity, but ultimately the tailwinds are there, I think, to support the Computershare business at around sort of 3.5% dividend yield on forward earnings, about 16 times 2014 numbers. We're happy to own it at around this 975 level, and we're selling calls up at around 1050, again boosting that cash flow up to around 10%. CSL, I think, whilst it's very expensive up here, trading about 20 times forward earnings and on a 2% dividend yield, we look for the company to provide further guidance around their third round of share buybacks. They've already bought back $1.8 billion worth of stock in the last 2 years, and we're looking for them to confirm that they're going to engage in a further $500 million buyback in the 12 months ahead. If we get that, I think it should underpin CSL. From an earnings growth standpoint, the company's likely to deliver about 10% EPS growth over the next 12 months. Not doing there in Crown nor in Dexus. Fortescue, so as is the case with BHP and Rio, I think we could start to see some upgrades to the earnings outlook here for Fortescue. Short term, though, up at around these levels, the stock probably starts to get a little bit expensive, somewhere between this sort of 490 and 550, but we could see it continue to push a little bit higher as the company sort of ramps up its production from the current sort of 115 million tonnes per annum up towards that 155 million tonnes per annum. With iron ore prices where they are, the company's able to manage its debt levels a lot better than markets were fearing when iron ore was trading back down around 90 US a tonne. So there's still the possibility of a positive catalyst coming out of its infrastructure asset sales, but right at the moment with iron ore prices where they are, there's less of a focus, and the company's managing its debt levels. So on a forward basis, we could continue to see Fortescue do reasonably well, I think. Fox, so about 8 to 10% EPS growth over the next 12 months. The real story here is the company conducting this $4 billion share buyback. We've been owners of it on these dips at these levels, and we're selling covered calls up at around the $36, $37 level. I think that caps the upside for Fox. Goodman Group, I'd spoken about it getting yield support down here at around $4.50. At around $5, it compresses that yield back down to 4%, and I think that's, you're not getting rewarded for the risk. So the new range for Goodman is $4.50 to $5. Ultimately, though, I think it's one of the more exciting property plays. I think they're in the faster growing segment where we're probably likely to see high single-digit earnings growth, maybe sort of 7, maybe 8% EPS growth out of Goodman over the next few years. GPT, I think, just forming that base probably a little bit earlier in the piece than Goodman, but from a yield support standpoint, GPT starts to look attractive down here on a forward yield of about 5.75, almost close to 6%. We'd expect it to consolidate around these levels at around 3.80. I think it starts to look a little bit expensive as that yield compresses back down to around 5%, but expect it to find support at or near these levels. IAG not doing there at the moment, or in Iluka. IPL comes up to paying their dividend in November. We'll look for commentary out of the company around earnings. I think the issues here is that really any benefit that they've got from the lower Aussie dollar has been impacted by plant and operational delays. So where we were looking for sort of 10% EPS growth, I think IPL might be lucky to deliver flat earnings in the 12 months. To put some numbers around that, the stock trades about 12 times forward earnings on about a 4.5% dividend yield. Lend-Lease, so we've been buyers of this at lower levels. We've sold the covered calls up at around 10.25, which gives us an effective exit of around 10.50. We're boosting that dividend yield from around 4% up to 10% cash flow, and also allowing for some capital growth given that we own it at lower levels. The company guided towards pretty flat earnings. However, management had made comments that over the next 3 years the business growth should return to reasonably robust levels. We interpret that as management expecting the company to deliver high single-digit earnings growth, maybe 8, 9, up to 10% EPS growth. Puts the stock at around 10 times forward earnings and about a 4.5% dividend yield. MGR, we've taken profit on this after owning it at lower levels. We sold out at 178. I think maybe somewhere back down here at a 165 we're willing to take another look. Probably we're more drawn towards Transurban and Stocklands at the moment. Macquarie comes into its dividend period. Some very high growth prospects priced into Macquarie, looking for a 2014 earnings to grow at around 20-25%. I think sort of the backdrop's there to support Macquarie, but certainly getting expensive up at these levels. NAB, we continue to own ANZ, NAB and Westpac coming into the upcoming dividends. We've mostly sold European calls at around $33 in NAB, so allowing for the dividend, we're really locking out any upside much above sort of $34, but again we do own it at lower levels. Looking for maybe sort of 3 to 5% EPS growth there for NAB. Got it on 13 times earnings and about a 6% dividend yield. Newcrest, interesting, the upcoming AGM, we'd expect to see 2 board members removed at the upcoming AGM. Hopefully that becomes a bit of a catalyst for the company to focus on some decisions around their higher cost mining, gold mining assets, and focusing on the lower cost production. That will depend on obviously the board's longer term outlook for gold as to whether they think it's going to find support out on near this 1,300 an ounce, or whether they'll begin to trim the business back on the basis that some of the higher cost production mines will be closed, with a focus on the lower production costs and hopefully a return to profitability. But hopefully a positive catalyst for an improvement in Newcrest share will be the upcoming AGM and the removal of 2 of the directors, so we'll keep focused on that over the upcoming radio recordings. Origin Energy, so from a valuation standpoint, the company first of all disappointed a little bit in their last earnings result. The market was looking for 10% earnings growth. They delivered flat earnings growth, or actually slightly negative earnings. On a forward basis, the market's pricing in about 10% earnings growth. The real story for Origin is, I suppose, we're starting to see a little bit of de-risking around their capital expenditure with their LNG projects. I think when you compare Origin, Santos and Oil Search, arguably on a 3-year outlook, Origin's the most attractive from a profit return perspective, from where the business sits today and from PEs. But right at the moment the stock trades about 19 times forward earnings on a 3.5% dividend yield, and we're already asking the company to go from essentially a negative prior 12 months to delivering a 10% growth in the 12 months ahead. So I think we're sitting at the top end of the valuation range. I expect it to sort of consolidate and move sideways. Not doing there in Orica. Oil Search not doing there at the moment. We'll come back to that in the next few weeks. Recordings, nor in Qantas. QBE, as we've seen the US yields move lower, we've seen the Aussie dollar move higher. Both are negative for QBE, but I think ultimately if the US market finds support at around 14,500 points on the Dow and the US 10 years find support at 2.5%, I'd expect QBE to find support at around $14.50. The stock trades at about around about 15 times next year earnings and on about a 4% dividend yield. It's on the radar, and we start to have a closer look at it as it pulls back into our valuation range here. Rio, as with BHP, I think could be facing earnings upgrades here with the stronger iron ore price. I think in that environment we could see Rio trade back up towards sort of 65 to maybe 69, $70 over the next 6 months. Out of the resource names, we're still drawn towards an exposure to BHP and Woodside Petroleum, though. Stockland, so they're on a very high payout ratio. They've maintained their dividend even though they had fairly limited earnings growth over the last 12 months. On a forward outlook, we're looking for about 5% EPS growth into 2014. The stock trades at about roughly about a 6% dividend yield. So I think this is one way of getting exposure to obviously a recovering Australian property market. The residential side of Stockland's portfolio should continue to do well. The commercial side, probably limited earnings growth there. Our strategy is to own it at these levels and sell the covered calls, collect the upcoming dividend. My base case for Stocklands is that it largely trades sideways at or near these levels, but again we're delivering 10% cash flow as a result of the dividend and call premium, and we'd expect to hopefully lock in some capital gains if the stock was to rally up and take out the top end of that call option strategy that we have in place there. Not doing there in Sonic. Santos, we've taken profit there. I think just starts to look a little expensive for our liking. To put some numbers on that, it's trading about 22 times forward earnings and about a 2 to 3% dividend yield there on Santos. Not doing there in Suncorp. Sydney Airports, whilst it's reasonably attractive from a defensive yield play, our preference is Transurban. We've seen the company come out today, and the third quarter traffic numbers for Transurban were slightly ahead of expectation. We'd expect solid dividend growth over the next 2 years from the current range of around 34 cents, maybe up to as high as 42 cents a year in a payout ratio. So whilst you're buying the stock at these levels and only achieving sort of a 4.5–5% dividend yield, with the call premium that we collect, we're building that up to around 10% per annum. But the underlying business, we'd expect to see continued earnings growth to support probably ultimately a 7 to 7.25 price target over the next 6 months, and then maybe 12 months out, maybe up to 7.50. I guess what all investors need to keep into consideration is a lot of these yield names have had a good run off the back of a falling interest rate environment, both globally and here domestically, and ultimately as we start to see the Australian interest rate cycle bottom out next year, that tailwind that has created the huge adjustment in valuations in some of these names will not exist. Now our base case is that it doesn't correct to the downside. We get sort of a prolonged consolidation period in some of these yield names, which will actually be a very good environment for running the covered call strategy. Telstra, similar situation there. So Telstra's mobile strategy is continuing to win the market share. From a valuation standpoint, we've got Telstra trading at around 15 times forward earnings on a 6% dividend yield. We're probably looking at low single-digit earnings growth in 2014, but I think coming into the February-March dividend, we could see Telstra push up a little bit higher towards this sort of $5 to $5.25 range, and I think you'll just see this pattern where post-div the stock will pull back 5 to 10%, and then rally back into the next dividend period, but continue to have allocations towards Telstra. And Toll, so a little bit disappointing here, I suppose, from a earnings growth perspective, but certainly from a share price performance, it's fitted very nicely in with our target. We had support down at around $5 and resistance at $6. We own the stock sort of at the lower $5 range. We've been selling the $6 calls, so we're boosting that dividend stream from around sort of 5% up to 10% plus per annum. From an earnings growth standpoint into 2014, I think Toll will probably be lucky to deliver about 5% earnings growth. So our base case here in Toll is that the stock largely trades sideways with fair value at around that 550 range. Westpac again around 3% EPS growth, about just over 5% dividend yield. Westpac and ANZ are probably where we see the most value now within the banking space. WDC, as we've seen them spin off or sell off a lot of their non-core assets, we should start to see a better return on equity here for WDC going forward. The stock trades about a 4.5% dividend yield. I think at around $11.50 it captures the full upside, so we've been selling calls at around the $12 level here in Westfield, again sort of boosting that dividend yield up to 10% plus per annum. Wesfarmers about 6% earnings growth, very high PE into 2014, trading at about 19 times forward earnings and about a 4.75% dividend yield. In saying that, we're still happy to own it at these levels. We've been selling the 42.50 calls, so again boosting that cash flow up to 10%, but giving us some opportunity for some capital growth. But to build an argument over the next sort of 3 to 4 months that Wesfarmers trades too much above $42 or $43 a share, given that we're already paying 19 times next year's earnings, I think the stock looks reasonably expensive and sort of fits in with this scenario that we think that it's a defensive yield name that's probably likely just a bump sideways from current levels. Woolworths, so we've been buyers of Woolworths, has had a slight pullback. Probably that sell-off has been driven by some of the negativity around the contractual arrangements that may come to the fore next year with Lowe's on the home improvement assets that Woolworths has partnered with them on. We'll wait and see whether ultimately we end up with some type of accounting write-down on that next year. I think that negativity in the market this week really has created a buying opportunity down here at around sort of $33.50 to $34. Woolworths is good value. From a yield standpoint, the company should grow earnings about 5 to 6% at about a 17 times forward earnings and a 4.25% dividend. It's expensive, but as with Wesfarmers, we're happy to own it. We're selling covered calls at slightly higher levels, again boosting that dividend yield up to 10% per annum. And finally, nearing the end with today's presentation, Woodside Petroleum. So we've seen some commentary in the market around Woodside maybe taking out a 10 to 15% stake in Oil Search. I think at a 6.5% dividend yield, the prospect of about 7 to 8% earnings growth over the next 12 months, we've been buyers of Woodside Petroleum on this pullback. Our target here is to see the stock back up towards around $39 to $40 over the next 3 months. But as I've mentioned earlier, Woodside and BHP are still our preference within the resource space. WRT, not expecting a lot here out of earnings growth, but well supported from yield, about a 6.5% dividend yield. The company does have a small amount of shares to finish off their current buyback. At the margin, that remains supportive. We're not looking for much earnings growth in the 12 months ahead, but owning the stock at or near these levels and selling the 315 to sort of 310 to 320 covered calls gives us an annualized return in excess of 20%, as well as sort of a 10% cash flow as a result of the dividend and the call premium, even if the stock continues to bounce sideways. But Westfield Retail, I think, is reasonably defensive within this property play environment at the moment. And finally, back to the broader index there, which is an index of the top 50 stocks. Okay, so to conclude today's recording, our base case for equities is we're of the view that the US, whilst volatility may persist for up to another week, ultimately we'd expect to see the debt ceiling raised and a compromise met on the budget. With equity markets trading, or in particular Australian market trading, about 14.5, 15 times forward earnings, offering a dividend yield of around 4.5%. With a low global bond yield alternative, I think equities continue to remain attractive. We're drawn towards the best quality names within the market, with focusing on those companies that are likely to deliver earnings growth into 2014. We're recognising that we're paying reasonably high multiples for those names, so we're complementing it with a very tight covered call option strategy as driving good income as a result of the dividend and the call premium, and still allowing for some capital growth. And I think that's the right strategy, just a matter of getting the right asset mix across those names that I'd mentioned in today's recording. Thank you for listening in. I look forward to speaking again next week.